The primary disadvantages of buying real estate include high transaction costs, illiquidity, and greater idiosyncratic risk compared to stock market investments. The best strategy for growing your net worth over time is to defer as much consumption as possible so you can grow and invest your savings. In an ideal world, you should have a diversified portfolio which contains both real estate and stocks. Here are 3 disadvantages of buying real estate versus stocks. High transaction costs. Buying real estate is very costly due to high buyer and seller closing costs, especially in New York City. Whereas with stocks, you can make a 5 or low 6-figure investment and pay just a few dollars in fees. For real estate, your buyer closing costs are at least 1 to 2% for a co-op or 4% or more for a condo or a house. Because of the high closing costs, real estate is only a worthwhile investment if you plan on holding on to your property for an adequate amount of time. Buying and selling every few years will erode most, if not all, of the gains you've accumulated from owning real estate in the first place. Illiquidity. Real estate is an illiquid asset, which means it's both time-consuming and costly to buy and sell. Whereas with stocks, you can sell and receive the money in a matter of days, for real estate it can take 6 months or more to complete the sale process and receive your sale proceeds. If you're in the unfortunate situation of having to sell in a buyer's market, the sale process could take a very long time, and you might not be happy with the outcome in terms of the sale price. Stocks fall as much, if not more, than real estate during a recession, but at least you're able to generate cash quickly if you need to sell. The average time it takes to sell a co-op in New York City from start to finish can take 6 months or more. Once you're in contract with a buyer, it still takes another 2 to 3 months on average to complete the board application process and receive the clear to close. Idiosyncratic risk. Owning real estate carries a great deal of idiosyncratic risk, which you simply cannot hedge against. Another way to describe idiosyncratic risk is non-systemic risk. For example, you're completely out of luck if there's a natural disaster or your tenant stops paying you and doesn't move out. Contrast this with stock market holdings, whereby you're so diversified such that there would never be a scenario where 100% of your investment is paralyzed or substantially impaired. The law of large numbers and diversification with a balanced stock portfolio means that the only risk you take is market-wide risk, also called market beta. Looking to buy or sell a home in New York? Learn how you can save on commission and closing costs at www.hauseit.com.